They say history repeats itself, but in the financial world, it doesn't just repeat. It follows a script. Every time the stock market collapses, it looks like chaos to the average person. But if you zoom out far enough, it becomes choreography, and only a few know the steps. The headlines scream unprecedented downturn, historic losses, Black Monday, and the public panics. But behind the curtain, the same cycle plays out, again and again, quietly rewarding those who know what's coming. It always begins with a boom, an extended period of optimism, expansion, and easy credit. Everyone's portfolio is green. People feel smarter than they are. House prices go up, stocks go up, retirement accounts grow. And then, slowly, cracks begin to show. Not on the news, but in the portfolios of the insiders. Hedge funds and investment banks start repositioning. They reduce exposure. They hedge. They know the pattern. Because they helped write it. When the fall comes, it's fast. Fast enough to feel like disaster, but slow enough for those at the top to prepare. In 2008, the average American watched their 401k shrink by half. But what most people didn't know was that many of the largest players had already exited toxic positions months before. Goldman Sachs, for example, was publicly packaging mortgage-backed securities while internally betting against them. That's not miscalculation. That's a business model. And it's not just about avoiding loss. Crashes aren't the end of the game. They're the beginning of profit. The same companies that exit early re-enter when panic is at its peak, when prices have collapsed, when retail investors are dumping stocks out of fear. That's the real buying moment, not when CNBC says the market has stabilized, but when blood is in the streets. Every crash looks like the end of something. But for those who understand the game, it's a reset, a transfer of wealth, not by theft, but by design. Assets don't disappear in a crisis. They just change hands. From the uninformed to the prepared, from the emotional to the strategic, from the public to the powerful. Most people see a crash as a crisis, but for the top 1%, it's a playbook. And every 7 to 10 years, they run it again, with better tools, better data, and even less oversight. The only question left is, when the next one comes, will you still be watching the news, or will you finally understand the script? Every financial crash begins with too much optimism and too little memory. The markets rise, valuations stretch, and the same voices who warned last time suddenly go silent, or worse, become cheerleaders. But while the public celebrates another year of record highs, those in the know are already preparing their exits. Overexposure is never a surprise. It's engineered. Wall Street firms push products that inflate markets, over-leveraged housing loans in 2008, dot-com IPOs in 2000, meme stocks and SPACs in 2020. They know these things won't last forever. That's the point. The cycle doesn't depend on stability. It thrives on excess, followed by collapse. Take 2008. Mortgage-backed securities, MBS, flooded the market. They were stamped AAA by rating agencies and sold as safe. Banks like Goldman Sachs were the biggest sellers. But behind closed doors, they were shorting the very same products, betting they'd fail. The internal memos are public record now. Executives referred to the securities as junk and crap, but the profits were too good to stop the machine. They didn't wait for the public panic. They moved before it. Months before the crash hit headlines, portfolios were rebalanced, risky assets unloaded, credit exposure reduced. The exits were quiet. No alarm bells, no press releases, just strategy. Because the goal was never to ride the wave forever. The goal was to ride it until just before the break. And while the top tier was cashing out, they were also laying the groundwork for the next stage, buying power. Crashes provide cover. When everyone else is scared, it's easier to move without scrutiny. Panic distracts. Retail investors freeze or flee. But institutions? They reposition. What the public calls unpredictable, insiders call inevitable. Not because they see the future, but because they build the structure. They know when risk becomes unmanageable. They understand when to flip the switch. And by the time the news tells you it's time to worry, it's already too late. This isn't speculation, it's precedent. Over and over, big money gets in early and gets out quietly. Everyone else? They're still waiting for permission to sell. So the next time markets are booming and your financial advisor says, "We're in a strong position," ask yourself, who's selling while you're still holding? When crashes hit, they don't lose access. You do. Liquidity is the lifeblood of the financial system, until it's not. And when the panic starts, it's not just market value that disappears. It's your ability to move, to withdraw, to act. Every crisis starts the same way. Prices fall, volatility rises, and suddenly your options vanish. Try calling your bank when the Dow drops 2,000 points in a day. Try moving funds from your brokerage account when circuit breakers halt trading. Try withdrawing large sums from your savings when fear hits the streets. The doors aren't locked. They're just processing, temporarily, for your safety. But while you're waiting on hold, big players are already moving. They're not stuck in a queue. Their funds aren't frozen. Their access isn't throttled. Why? Because they're not operating at your level. They don't use the same rails. They don't need permission. In fact, they anticipated the freeze before it hit. Think back to March 2020. The pandemic panic triggered one of the fastest market drops in history. Retail investors were scrambling to sell, move cash, reduce exposure. But the systems weren't ready. Brokerages crashed, apps froze, withdrawals were delayed. Meanwhile, institutional investors were executing billion-dollar trades without delay. Because the architecture is different for them, they don't use the front door. The same pattern repeated in 2008. Small business owners couldn't get bridge loans. Families couldn't refinance. People lost homes because the money they needed wasn't available. And at the exact same moment, government backstops were handed out to megabanks, not to the public. Who got hurt? Who got rescued? Who made billions? Here's the truth. Liquidity is not just about cash. It's about priority. And in times of crisis, you are not the priority. Retail investors are told to diversify, to ride it out, to stay calm. But the ones giving that advice? They're moving fast, consolidating assets, buying distressed companies, and reshuffling their portfolios while you refresh your news app. They don't lose access when the crash comes. You do. And by the time your screen unfreezes, the opportunity and the control are gone. Fear drops prices. Their timing prints profits. When most people panic, they sell. When insiders see panic coming, they short. That's the difference. One loses sleep, the other makes money. Shorting isn't some villainous trick. It's a calculated position, betting that an asset will drop in value. But what makes it powerful isn't the tactic itself, it's who uses it and when. In early 2008, just before the financial world imploded, several major hedge funds took massive short positions against mortgage-backed securities. These were the same products the public was told were safe, diversified, AAA-rated. The funds didn't guess. They knew, because they were close enough to the engine room to smell the smoke. And when the collapse came, they printed billions. This isn't limited to historic cases. The same logic applied in March 2020. As the pandemic triggered lockdowns and supply chain freezes, some institutional investors shorted airlines, hotels, cruise companies, all before the headlines caught up. Retail investors were still booking spring vacations. Insiders were betting on blood. Shorting works because fear is predictable. It moves faster than logic. It spreads faster than data. And when the market reacts emotionally, prices overcorrect. That's not bad news for those with a plan. It's an invitation. And here's the next move. They don't just profit on the way down. They buy back everything on the way up. Once panic has done its work, once stocks have dropped 40%, 50%, 60%, the same institutions begin quietly reversing their trades. They start buying cheap assets, broken companies, undervalued tech, real estate, commodities. Whatever fear discounted, they collect. You won't hear about it. You won't see a breaking headline that says, "The rich just re-entered the market." Because that's not how this game works. It's not about public announcements. It's about positioning. Retail investors are taught to wait for signals, economic indicators, job reports, Fed decisions. But by the time those arrive, the institutional money is already back in. They shorted early. They bought the bottom. You're just hoping to break even. This is not a conspiracy. It's a model, a cycle. One that relies on two things: predictable panic from the crowd and strategic patience from the few. If you're always waiting for the storm to clear, you're not just late, you're predictable. And in this game, predictable equals profitable. For someone else, by the time you read the headline, the move already happened. The financial markets don't move on facts. They move on narratives. And narratives are written before you ever see the headline. Most people believe they're staying informed when they follow breaking news. They think financial journalism exists to warn them. In reality, it serves to react to moves already made, often by those who influence the very stories that get told. In the lead-up to the 2008 crisis, Lehman Brothers had been collapsing for weeks. Insiders knew the bank was over-leveraged, toxic, and bleeding. But the media silence was deafening until the exact moment it served a purpose. When the headlines finally hit, Lehman implodes, market panic spreads. It was already too late for the public. The exits were already crowded. The institutional money had already repositioned. This isn't a one-time event. It's a formula. And it happens in cycles. In March 2020, as COVID fears exploded, the narrative shifted almost overnight. Global shutdown, market chaos, unprecedented times. But the fear had been circulating in executive meetings and closed-door briefings for weeks. Large hedge funds and investment banks were already unloading risk, shorting vulnerable sectors, and hedging aggressively. The public saw panic. They saw strategy. Why does this matter? Because timing is everything, and information controls timing. Media isn't neutral. It's owned. And when you trace the ownership of the major financial outlets, CNBC, Bloomberg, Reuters, Wall Street Journal, you find connections to the same institutions managing trillions: BlackRock, Vanguard, State Street, the same firms that own large stakes in the companies being reported on. That's not journalism. That's brand management. So when the average investor reads that markets are overheating, it's not a warning. It's often a justification, a tool to validate moves that already happened. The crash begins first in boardrooms, not in headlines. And even when the panic is real, the tools to respond are asymmetrical. You get advice: stay the course, don't panic, buy, and hold. They get access, leverage, private equity deals. You follow sentiment, they shape it. Every time you refresh your screen looking for the next clue, remember, you're not in the control room, you're in the waiting room. If the market is a stage, then retail investors are the audience. But the real drama? It unfolds backstage. You wait for the market to be safe. They wait for it to bleed. Most investors act like firefighters who show up only after the building has stopped burning. They want safety, clarity, a green light from the media or their advisor. But by the time the market feels safe, the real opportunity is already gone, collected by those who bought during the smoke and flames. This is one of the biggest psychological divides between retail investors and the elite. The difference between comfort and conviction. In every major crisis, whether 2000, 2008, or 2020, the middle class waits for recovery signals, news stories that say, "The worst is over," charts turning upward, talking heads giving permission to re-enter. Meanwhile, institutional players don't wait for comfort. They buy when prices are irrationally low, when fear is still in the air, when ordinary people are still selling to cut losses. This isn't a reckless gamble, it's a calculated pattern. In March 2009, while retail investors were still exiting the market in fear, insiders were already pouring money into equities. They knew that valuations had dropped below intrinsic value. The S&P 500 was bleeding, and that was the point. The worst-case scenario had already been priced in, and they had the capital to act before the headlines shifted. Same in 2020. When lockdowns froze the global economy and markets plummeted, small investors waited for reassurance. Big money didn't. They were buying airlines, cruise lines, and energy stocks while headlines screamed collapse. Because when you have access, information, and time-tested models, you don't buy based on how the world feels. You buy based on what it's become undervalued to. And when the recovery finally arrived, prices had already doubled. The retail crowd celebrated their small gains, but the ones who entered during the bloodbath, they were already exiting with profits and preparing for the next cycle. You've been taught to fear volatility. They've learned to use it. Because real wealth isn't built by waiting for the green light. It's built by entering the tunnel while others are backing out. They don't invest in safety. They invest in mispricing. They don't chase recovery. They catch the fall. And by the time you re-enter the game with your confidence back, you're not building wealth. You're just buying what they already flipped for a gain. Your fear is their margin. Your patience is their price tag. Every market signal you think is neutral isn't. It's reading you. Your reactions, your fear, your hesitation, all of it becomes data. And that data turns into decisions made by people who aren't guessing what you feel. They're measuring it. There's an entire industry built around tracking emotional sentiment in the market. Surveys, volatility indexes, trading volumes, all of it tells the story of how the average person feels. And when the crowd feels euphoric, institutions exit. When the crowd is in panic, they enter. Because emotion creates mispricing. Fear pushes value below reality. Greed inflates it above reason. And the delta between what something's worth and what you think it's worth, that's their opportunity. Take the fear and greed index, something most investors glance at without realizing its weaponization. When it plunges to extreme fear, institutions see blood in the streets, not a reason to run, but a signal to deploy capital. And when it spikes to greed, that's when they start quietly moving out. In 2020, retail investors rushed into the market after the initial COVID panic passed. Stimulus checks hit accounts. Robinhood downloads surged. Stock tips flooded TikTok. Emotion created buying pressure. But those who entered early, in the dip, while the fear was thick, were already up 30%, 50%, 70%. That margin? It was made possible by your emotional delay. This is why financial media thrives on alarmism and euphoria. Markets crash. Record highs. The louder the emotional response, the more predictable the flow. Predictability is what the institutions need to stay ahead. Even patience is a product. When you hold because you're told the market always recovers, you keep your money parked exactly where they want it. Your trust in long-term stability subsidizes their short-term maneuvers. You think emotion is just a side effect of investing, but for them, it's a blueprint, because if they can predict your panic, they can monetize your exit. If they can trigger your confidence, they can unload their risk. In this game, your feelings aren't just responses. They're revenue streams. They don't predict the crash. They position for it. You've been told that the secret is timing, that if you just knew when the market would drop, you could get out in time, buy the dip, ride the wave, beat the odds. But here's the uncomfortable truth. The ones who win don't time it perfectly. They don't need to, because they already understand how the system moves, and they've built positions that thrive in either direction. They don't chase stability. They build frameworks. While most people wait for the all-clear sign, the "markets are recovering" headline, the "experts say it's over" reassurance, the elite already moved, not because they guessed the exact day, but because they operate from a playbook that assumes collapse is part of the rhythm, not a surprise, a cycle. That's why they don't panic, not because they're fearless, but because their models don't rely on everything going right. They factor in risk. They calculate downside. They hold liquidity. They buy assets that generate cash flow even in downturns. They diversify across geographies, instruments, timelines. You, on the other hand, were taught to react, to follow signals, to listen to institutions that already made their moves before you even saw the headline. You're told to stay calm, ride it out, invest for the long run. But no one ever showed you the rules behind the curtain. This isn't a conspiracy, it's just architecture, and once you see it, you can never unsee it. The real advantage isn't in predicting the next crash, it's in preparing for the next cycle before the headlines confirm it. It's in thinking like a builder, not a survivor. In holding tools, not hope. Because the next crisis, whether it's economic, political, digital, or viral, is not a matter of if, it's when. And when it comes, the same patterns will unfold. Panic will hit headlines. Small investors will exit. Big players will buy. The cycle will reset. And the public will wonder what just happened. Again, unless you stop watching the news and start reading the model. Unless you stop asking when and start asking how. Because crisis isn't chaos. It's choreography. And unless you learn the steps, you'll keep sitting out the dance, while others collect the profit.